It's 8:30 a.m. Eastern. Welcome to FX Streets. My name's Adam Rosen. Very happy for you to join us. It's December 14th, 2010. Before we get started with a technical analysis discussion, really briefly, this was on Bloomberg.com just a little while ago. The UK inflation rate unexpectedly accelerated to a 6-month high in November, adding to the case for policymakers to rein in cost pressures. Consumer prices rose 3.3% from a year earlier after a 3.2% increase in October. That's said by the Office for National Statistics in London. Food prices jumped 1.6% on the month, and it's important because, again, those are 6-month highs for UK consumer prices. In other words, inflationary pressures. Gives the Bank of England more case to raise interest rates. Now, of course, there's a lot of cross currents in the market at any one time, but our job ultimately is to identify those currencies and those central banks that are most likely to raise rates and least likely to raise rates or most likely to cut rates. And, you know, we've talked about the UK economy for quite a while, and I don't think they're going to raise rates, maybe in the next month or so, but consumer prices inflationary pressure has increased over time. Today is another piece of evidence. We've had the PPI number out the other day as well. Be on the lookout for some pound strength in the anticipation the Bank of England will raise rates one day. I think it will happen sooner than the European Central Bank for sure. Now, today we're going to talk about technical analysis, and there's a very specific type of format I like to follow in terms of technical analysis. If you have any questions, if there's any specific currency pairs or markets that you'd like to see, please let us know. And we'll jump right to them. What we're looking at right now is the Dow Jones Industrial Average Futures. The symbol is YM on a daily chart. I always like to start with daily charts. Now, sometimes we might need slightly longer-term charts, like the weekly or the monthly charts, and we will address those charts when it is necessary to do so. But what I'd like to do is just take you through, let me erase all these lines and really take you through from the beginning, take you through what I like to use, a little bit of a system I like to use in terms of the charts. And I think it's a good habit to go through the charts on a daily basis. When you open it, when you turn the computer, revisit the charts to refresh the your memory of where the market sits in its position, because it's so easy to, once we get started trading, to get sort of lost in the short-term charts. The euro dollar goes up for the day based on news, based on a piece of, economic news that's released, and sometimes we tend to forget, well, the long-term trend for the euro dollar is this, and maybe I'm fighting that trend, and that's not good. So I always like to start with the long-term charts. It's a very simple exercise. It doesn't take more than a few minutes. It's a very good way to start the day. Dow Jones Industrial Average, these are the futures. They do vary a little bit from the cash market, but not a lot. Now, in this case, we'd like to start with a monthly chart. How do we know? Because the pattern is so significant that I think it deems worthy to do so. What's the pattern we're looking at? This is a possible massive head and shoulders pattern. It's a very common pattern in stock markets. I think it's even more common in foreign exchange markets. A head and shoulders is very simply a triple top where the highest high is in the center, where the center high is higher than the first and the third high. The first high in the triple top, or in other words, a head and shoulders, takes us to 11,853. Those were the highs January of 2000, 11,853. Now, we can actually adjust this line almost exactly, and of course, it will vary, 853. Excuse me, it will vary, depending on whether we're looking at the cash or the futures markets. But regardless, we can see the stock market, the Dow Jones Industrial Average, came up to a certain point, 11,800 in the year 2000, pulled back down to a level of, what are we looking at over here? The lows of 7180. 7180 were the lows going back to October of 2002. Let's adjust these lines out. 7180. Now, in a monthly chart, we don't have to be exact by far, but it's nice. Then we rallied up, and then our next sign, our real piece of evidence, was the market made higher highs. Well, we know in an uptrending market, the market tends to make higher highs and higher lows. It looks like we're walking up a flight of stairs. But the problem is we did not make higher lows. We just made higher highs. The next piece of evidence is really most important. If the Dow was able to make higher highs when we came up to 14,262, those are the highs of October 2007, we should have made higher highs. At the minimum, we should have not made lower lows. In fact, we did. Remember, the former lows were 71.80, and we came down to an even lower low of 64.57 more recently. That was March of 2009. Why was the market able to make a higher high and then ultimately a lower low? That's not good. It shows a lot of indecision. It shows us the buyers are stronger than the sellers at this point, but then the sellers are stronger than the buyers. It's not logical why this happened. So, from that point moving forward, now we rally back up. The head and shoulders typically is known to break in the opposite direction of the head. In this case, the head is at the top. The head's at 14,262. The rule of thumb is the head and shoulders, the third shoulder, or I should say, the second shoulder, the third top, should not go too much far above, should come pretty close to the high of the first shoulder. First shoulder high, again, was 11,853. 11,853 is approximately our target for the second shoulder. That's where we should not cross above. Now, sometimes it'll fall short, sometimes it'll move a little bit above, but generally speaking, we're looking for the second shoulder to come in very close to the high of the first shoulder. If we break cleanly above this 11,853, we have a better chance to revisit those 14,262 highs and then turn very much to the downside. And then break out even more to the upside. If we do, in fact, clear 11,853, I like to round it off. We'll call it 12,000 to be certain. Now, if you've noticed, we also have the similar pattern, not as significant, but to the downside. We have a first shoulder low in what could be an upside down head and shoulders, 71.80. Then we have the head at the bottom, and an upside down head and shoulders. That's the bottom at 64.57. And then we have the possible second shoulder, that's at 71.80. So, if we think the market is going to go up, and unfortunately, the position of the market right now is not where we want it, not where we want it to be if we want to take a trade. In other words, if I think the market's going to go down, I want to sell short. I have to wait for the market to go up. Near 12,000, 11,853, because remember, if the first shoulder was 11,853, then the second shoulder should come in very close. Therefore, I'm going to sell short just a little bit below this level and go long and place our protective stops a little bit above that level. I'll show you what I mean. Changing the colors here, we're going to say we're going to sell short. That's the entry, so we'll call that a green line. Let me know if you can't see these colors, by the way. And the stop level is now, I'm just sort of eyeballing where to place these lines. Obviously, I'm not paying attention to, how many points there are, but just to illustrate approximately how we want to place this trade. If we suspect that the head and shoulders is 11,853, we want to sell short just a little bit below that and place our protective stops a little bit above that. That's the strategy, assuming we think the Dow is going to go down. If we think the Dow is going to go up, then we would want to make a bet, make a trade based on the theory that we have an upside down head and shoulders. Therefore, we'd wait for the market to come down a lot. First shoulder lows was 71.80. We want to go long just a little bit above that. By the way, and our stops we place a little bit below that, placing our entry to sell short. Green lines are entry orders, meaning we have to get in the trade. Okay, there's our properties, and change that to green. There we go. So we want to go long just a little bit above what we suspect to be the neckline of an upside down head and shoulders, sell short just a little bit below, protective stops are placed on the other side of the first shoulder, whether it's at the bottom on an upside down head and shoulder or at the top. That's how we see the Dow Jones Industrial Average. Now we try to also factor in a little bit of the calendar. Where we sit in terms of the calendar. Does it make sense that the Dow Jones Industrial Average would be rallying up to this level, a very significant high, and then possibly turning sometime, I would guess maybe the first quarter of next year? Well, it does. We know that there's something, especially in the stock market, well, primarily in the stock market, it's called the January effect. You see, for those of us that have had winning stocks this year, winning investments this year, we're going to take profits in some of those trades. Maybe we bought Ford at $1, $2 a share. Now it's $10, $12, $14. We're going to take profits. We might also have some losing stocks. Well, what traders do is they sell losing stocks to offset the winners or offset the gains from the winning stocks. And that's why we see a little bit of a sell-off from time to time around October of the end of October, the fourth quarter of the end of the year. Now, the January effect is when the stock market tends to rally to the upside the first 2 to 3 weeks of January, when not only individual traders, but also these hedge funds and mutual funds reinvested capital back into equity markets after they've taken positions off the table for tax purposes. Stock markets tend to be strong the first couple weeks of the year. In fact, take a look at, and it's actually a pretty viable strategy. If we had gone long the Dow Jones Industrial Average, now granted, this is a little bit of an unusual situation, but 2003, 88.60, we can see we were very much, well, this is a monthly chart, so we'd have to zoom in a little bit, but we can see oftentimes going long the stock market in January would have been able to get in and make a nice little piece of profit the first couple weeks of the year. This is January of 2007. Now, of course, it's more important where we sit. That's January 2008. That was kind of a bad year. Regardless of that, now we have a better idea. Well, the stock market right now, the trend is your friend. Very much to the upside. Let's go to weekly charts. And based on a weekly chart, we can see that we have a long-term trend to the upside, and we certainly want to honor that trend. The stock market has gone from 7,000 to 11,000, but it shows very little signs of really changing anytime soon. Whoops, where did I change this line to? Whoops, there we go. But please be aware of a possible major change in the tone. Right now, we have a long-term trend to the upside. I can probably adjust this trend line as follows. There we go. Make it a little bit more perfect. Long-term trend to the upside, but please be aware, 11,005, 11,800, 12,000, possible real reversal point. Daily chart shows us right now we're in the midst of a long-term trend to the upside, and then we can start to draw more horizontal lines. Let's change this back to white over here. To show us very, very simply that sometimes our former resistance becomes new support, sometimes our former support becomes new resistance. Take a look at Head and Shoulders that ultimately broke to the upside. Do you think more funds look at Dow or S&P or the Standard & Poor's as a market proxy? It's a great question. I'm guessing actually this S&P might be a little bit more of a broad-based market in terms of funds because the Dow Jones Industrial Average only represents the 30 largest stocks in the stock market. The 30 largest stocks represent the U.S. economy, like General Motors and, well, not GM, but Ford, Microsoft, etc. S&P 500 are the 500 largest companies, 500 largest stocks. So I think the S&P 500 is a little bit more representative of the overall economy and probably what funds chase. But the Dow certainly is a very important benchmark to keep in mind. By habit, I've always focused towards the Dow. Let's focus now on foreign exchange. Let's take a look at some charts. Euro-dollar weekly chart, and these are charts that I've maintained for quite a while, and I keep them on the daily, weekly charts. Long-term channel to the upside, especially a long-term uptrending support level to the upside. Notice, this is a weekly chart. Notice about 3 weeks ago now, the weekly candle on the euro-dollar came down to lows of 129.68, but failed to break below that support line, failed to close below the support line. We know in candlestick analysis that these long candlestick wicks represent the high to the low or the low to the high of the market, but not necessarily the open to the close. The open to the close are the thick part or the body of the candlestick. So the fact that the candlestick was able to cross below but then rally back up is actually a bullish sign. It's a positive sign the euro-dollar will stay higher. But we really want to stay above our 2-week lows. Those lows, 131.63 last week, 131.82 this week. And by the way, 129.68. 130 is a big number. And we want to make sure we stay above 130 in the euro-dollar. If we do stay above 130, I think the euro-dollar has a good chance to continue higher. After all, the long-term channel is to the upside. And possibly make new highs. We could draw our support and resistance a number of different ways. either way you cut it, we have to at least revisit our former highs of 142.81. Not a bad risk-reward ratio. If we stay above 130, we have a good chance to revisit highs near 142, 143 almost. Pound dollar daily chart is a different story, 158.10. Notice, and I like to draw these support lines because they tell us a very important story. They tell us a story of how the euro dollar is so far above its support line, or is really trying to do so. And remember, we took a look at the Dow Jones Industrial Average for a moment. We'll go back. We're still above. Weekly chart shows us long-term support line, and that's good. That support line is a lower line, by the way, is established by connecting very significant lows. What is different here now is we take a look at the pound-dollar currency pair, and unlike the Dow, unlike the euro, the pound has already broken below its long-term support line. The rule of thumb is what was former support oftentimes becomes new resistance. Take away these Fibonacci lines for a moment. In addition, remember the Dow head and shoulders? It's not alone. These markets are connected. We should ask ourselves a question. Why was the Dow able to touch almost 160 August of this year, get a little bit above 160, actually go up to 163 almost, but then all of a sudden we made lower lows? We made higher highs and we made higher lows, and that is good. We maintained our uptrending support line, but then we broke below the lows, and we also broke below the support line, which is basically one and the same. When we break below support, chances are we're going to break to new lows. And when we did so, it showed us that this higher high wasn't real. This higher high was basically a false breakout, and that pound dollar has a much, much better chance to move to the downside. We made lower lows also from the former lows of 156.48. We can draw downtrending support lines as follows, and all of a sudden, almost immediately, we have a new downtrending support line. And we can make a resistance line as follows. Oops. I'll show you how we do it. What we do is we draw a support line or resistance, draw a parallel line as follows, then we just drag that parallel line to project where resistance may be. These lines oftentimes are parallel. Now, the neckline of the head and shoulders tells us to get ready to sell short very close to the large round figure. That's 160. Downtrending resistance at the moment, 161. So I'm guessing, and then this high over here at 161.05. So I'm guessing 160 to 161 is where we want to sell short the pound dollar. Placing our protective stops a little bit above resistance. This blue line, by the way, would represent where we place our protective stops. We'll make that stop line red. Where we want to sell short, we'll make that line green. And that's essentially how we want to play this head and shoulders. Selling short just a little bit above our downtrending resistance, placing, or a little bit below our downtrending resistance, placing protective stops a little bit above, hoping to catch this turn. Because if we do, the final thing about the head and shoulders, which I kind of forgot to mention, but we'll mention now, is that we have a neckline. The neckline is the highest high. Let's go back to the Dow chart because that demonstrates the much. Actually, no, we'll stay with pound dollar. This just equally demonstrates it. We have the neckline, which is the highs of the shoulders. Then we have the shoulder line, which is the bottom of the shoulder. So you can imagine almost like the armpits. That is at 156, and then someone might argue actually down to 154.83. Let's cut it down the middle. Split it down the middle. Well, actually, we'll keep it at 156. 156 even. Basically, the bottom and the top of the head and shoulders, excluding the head. The head is at the highest high. What's the difference between 156 to 160? That's 400 pips. No. Yeah, 400 pips. 160 minus 156, 400 pips. Well, take that 400 pips and subtract it from the bottom, which is the shoulder line. 156 minus 400 pips is 152. That is our approximate price target, by the way. You have the same width from 156 to 160, shoulder line to neckline, subtract it from the bottom. In other words, take it away from the head, moving away from the head. That's our approximate price target. That's 152. and change. Now, in addition, I also would plug in Fibonacci lines, and oftentimes it gives us a further sense of confirmation. Draw the Fibonacci lines from the lowest lows up to the highest highs. 50% Fibonacci retracement level. Take a look at the lowest lows going back to September of this year. We look at lows of 152.95. So 152.95 lowest lows. Fibonacci is 152, or I should say, 152.50. And then our support lines is around 152. 152 to 153, approximate target to take profits. Ed Ponzi says that the grandfather technical analysis, which means less reliable now. Well, there are some proponents. I'll put it this way. And Ed's a smart cookie, so I won't disagree with him. But what I would say is this. Either the Dow Jones Industrial Average or foreign exchange is program trading. There is a lot of program trading in foreign exchange markets. Program trading is, obviously when you have these computers that make buy and sell trades on an automatic basis based on what the market does. And that tends to smooth out the market to a large extent. When the market goes down, these program trades will signal to buy, meaning try to catch the bottom. And when the market goes up, the program traders will try to catch the top, and then, the market gets very, very smooth. But at the end of the day, it really doesn't change it. Because at the end of the day, we read some news a little bit earlier today. The UK CPI was much better than expected. But overall, considering the upside. Eventually, what's going to happen is the Bank of England is going to say, you know what? We're going to raise rates. And before that occurs, I think that the market will wake up and say, hey, I think the Bank of England is going to raise rates a lot sooner than the U.S. will. Looking at the pound dollar, coincidentally, we can see that's probably not really the case right now, because the head and shoulders pattern is telling us the pound dollar is probably going to go to the downside, which means the buyers have probably bought as much as they're going to buy for the time being. And the sellers are probably going to regain control, especially if we stay below our neckline of the head and shoulders, which remember, 160 to 161. So that's the beauty of technical analysis, is that I can take my fundamental opinion and quantify it in very real terms. Yeah, I don't think the Bank of England is going to raise rates anytime soon. Despite the good CPI numbers, so far the market just hasn't woken up to that idea. And therefore, I'm going to sell short because the charts so far tell me to sell short. But if the pound dollar breaks above 161, I think that really increases the likelihood of a breakout and really increases the likelihood the Bank of England is going to raise rates. Program trading, I would say, I didn't necessarily read it anywhere, but just in my experience, program trading, I think, is much more prevalent in the foreign exchange market for a couple of different reasons. Very tight spreads, 24-hour market, which is huge, because program traders, they're going to buy and sell. What happens in the stock market, if we buy a stock or your program trading mechanism buys a stock at 3:55 p.m., 5 minutes before the market closes, and then you hold that stock overnight, and the stock closes at 50 and opens at 100, or closes at 50 and opens at 10, with a possibility to really lose a lot of money. Foreign exchange, 24 hours a day, 6 days a week, much better suited. And there's a lot more volume in the foreign exchange market. A lot of these program traders are very, very big traders. These are hedge funds and institutions. Not so easy to get in and out of smaller stocks. A lot easier to do so in the pound-dollar currency pair. But to go back to address the previous comments as we go to the Aussie dollar, I would say technical analysis is alive and well. I would say that there's always going to be a use for technical analysis. Now, what kind of technical analysis, whether it's tape reading, as was the case for stock traders for a long, long time, maybe not the case now, and whether it's something a little bit more eclectic like Elliott wave, Fibonacci, which is the basis of Elliott wave, some of the techniques that some members here have mentioned as well, or something a little bit more common like the trend lines. I think that's always the case. And you'll notice different currency pairs are more or less reliable, or different technical indicators are more or less reliable in different currency pairs. Dollar yen, for example, does not seem to behave well to trend lines. It consistently breaks trend lines. That's why I get very nervous drawing trend lines on dollar yen. Aussie dollar, it's a little bit nicer though. Generally speaking, I think you see the greater amount of volume, the better the trend lines actually behave, or the better the market respects the trend lines, meaning it's not going to break the trend line and then go back up. Less false breakouts is what I'm trying to say. Take a look at the Aussie dollar. Long-term trend to the upside. Support in an uptrending market, by the way, going back to basics, we always draw our support line first in a trend that's going to the upside, draw resistance first in a trend that's going to the downside. Generally speaking, expect support and resistance to come in pretty parallel fashion, which it did for quite a while on the Aussie dollar, eventually breaking out. First to the upside and then to the downside. Let's zoom in now on the Aussie dollar. And by the way, just for a moment, please be aware that the Aussie dollar very recently, just in the past month or so, hit levels a little bit above parity. By the way, we're at 99.98 right now. That's 2 pips below parity. That parity is when 1 Aussie equals $1 exactly. My charts go back to 1989. That's the highest highs we've ever seen on the Aussie dollar, at least in the past 30 years. That's pretty significant. When a stock or foreign exchange currency pair makes a new high for the month or the year, that's big. When we make new 30-year highs or all-time highs, that's huge. Trend lines did work for a while, but eventually they were broken. Once a trend line is broken, I'd like to take it away and redraw trend lines to more recent lows and highs. We can do so as follows. By the way, if you want to follow along, the lows of July of this year, connect those to the lows of August of this year. From July to August, uptrending trend line. Did we break? Barely, but we went back to the upside. And that was only really one day. And the low's closing price was 95.88. 9600 is our projected support line. That's okay. So far, we're above the support line. Let's draw a parallel line. Again, because oftentimes support and resistance come in a pretty parallel fashion. We're going to take the parallel line and just drag it up to the highs, well, the highest highs we've seen, connecting those last 2 recent significant highs. That's pretty encouraging. Remember, uptrending channel, always draw support first. Downtrending market, always draw resistance first. Now, someone mentioned very, very accurately, we also see now the possibility of a head and shoulders. First thing to do in the head and shoulders is mark off the highest high, 1.0001. Those are the highs of October 15th of this year. The rule of thumb in the head and shoulders is the second shoulder, this makes it easy, 1.0001. 1 pip above parity. Amazing. Second shoulder should not come in too much higher or lower than the high of the first shoulder. Take a look at today's highs. 1.0016, only 15 pips above the former first shoulder high. Now, if we close at the end of the trading day today, if we close above parity, and we see 2 or 3 candlesticks, and it's kind of tricky, because if you ask one trader, they'll say, I only want to see it close, but one daily candlestick close above this neckline. Someone else might say, I want to see 3 consecutive candlesticks close above resistance. A little bit of an art, a little bit of a science. However, once in our own minds we are certain that we have broken above this resistance, then it takes away the possibility of a head and shoulders, negates this trend line, and gives us a very good chance to revisit these all-time highs of 101.81 on November 5th and maybe go much higher. But if all of a sudden we see a reversal pattern, we've tested this level a couple times, today is the highest high. If we cannot close above this high, and remember where we sit on the calendar, the last week of the year, we don't really expect a lot to go on. We have Christmas, we have New Year's, the markets are closed. Markets get very, very quiet. In fact, if you take a look at the economic calendar, let's do so right now really quickly. fxstreets.com has a really nice economic calendar. I'll send everyone the link, by the way. If you click on the Fundamental tab, And we take a look at economic calendar and take a look, and what we're going to do, and I'll show everybody, we're going to the end of December, starting with obviously today, which is the 14th, and filter. Okay, now, taking a look at the calendar, and I'll send everyone the link. Why will the market move? Because of economic news. The anticipation of higher, lower interest rates. Well, today is December 14th, right? So furthermore, if you click on the advanced key, and you can filter out the only really, really big numbers. Let's see when the end of the really big events for the year take place. Very apropos, we're talking about it now. We had UK retail sales. We talked about your CPI. We have that Tankan number in Japan a little bit later on this evening. We have the federal interest rate decision a little bit later on today. Tomorrow we have UK jobless claims, the ZOO number. Well, that's the Swiss ZOO number. U.S. consumer price index, Swiss National Bank interest rate decision, Philly Fed manufacturing survey. December 17th, we have the Eurozone IFO numbers, Bank of Japan interest rate decision, December 21st. Ladies and gentlemen, that's about it. After December 21st, and that's the only Bank of Japan. After December 17th, today's the 14th, this is the last real week of movement, big moves that I might expect from the foreign exchange markets. This is it for the rest of the year. Except for the Bank of Japan, December 17th is basically, for all intents and purposes, the last volatile day of the year because that's the last day of really, really big news. Of course, the market can move for other reasons, but that's the last of the really big economic reports. And we know we need volume for a breakout, especially in the foreign exchange market. If we expect the Aussie dollar to break out to the upside, above parity, it's got to happen soon. Today's the 14th, by the end of the week. And that's how we can kind of use the calendar to time these moves. Now, on the other side, if we do not break above parity, and the market just seems to kind of do the same thing over and over, what it has been doing, hitting this parity level and stalling, and show signs of reversal back to the downside as we close out the end of the year, especially as we close out this week, I think we have a much better chance for the market to reverse to the downside. Notice, by the way, the shoulder line of the head and shoulders, 96.50, or even the lows of 95.37. Does this look familiar? Remember, neckline and then lower lows? Remember what the Dow Jones Industrial Average looked like? It's not a coincidence. These two charts look very, very similar. Going back to was it a monthly chart or a weekly chart? I think weekly chart. Remember, actually, the monthly chart is the really big head and shoulders. This is not on the same scale, but remember, shoulder, the head is a little bit higher, but then the shoulder is lower, and not only is the shoulder lower, the low of the shoulder is actually lower than the previous low. That really looks like the Aussie dollar, not on the same scale. But regardless, we're showing the market. In fact, if you go to a daily chart, the Dow Jones Industrial Average is not showing us a head and shoulders. What it is showing us, though, is a double top. Look at these long candlestick wicks. I like to draw a horizontal line at the highest closing price. The highest closing price was $11,398. That was in December 10th, just a couple days ago. Look at the long candlestick wick. So far, cannot get above 11,400. My theory is that if the Dow does not break above 11,400 and the Aussie dollar currency pair does not break above that parity level, it gives us a lot more confirmation of a possible reversal, especially running into the end of the year when we really run out of economic news. We run out of reasons why the market should break out to the upside or downside. More of a reason for the market to turn to the downside. But remember, the first 2 or 3 weeks in January, I would not necessarily sell short January 1st expecting a move to the downside because of that January effect. All that capital that's taken out of the market at the end of the year is reinvested January 1st through the first 2 or 3 weeks. But if memory serves correctly, February has not been a kind market for stock markets, a kind month for stock markets. I'm guessing if you look at a trader's almanac, stock market probably goes down a little bit more than it goes up in February. And if you're a fundamental bear like me, meaning if you look at U.S. unemployment at 9.8%, And yeah, some of the news has started to look a little bit better, but I don't think it warrants the Dow up at 11,400. That's my own 2 cents. Let's take a look at some other currency pairs while we have some time. Another significant, and by the way, if there's any pairs that you'd like to see, please chat them in. We don't have very, very much time left. A very significant pattern, though. Take a look at the dollar Swissy. This is a monthly chart. We're currently 96.48. Normally, I really don't like to use monthly charts unless the pattern is so significant that we really have to make note of it. Downtrending resistance is at 115.30. We're right now at 96.48. Now, over the past 2 to 3 months, we have made higher lows, and that is bullish. That is encouraging. It's, positive. This month lows of 95.95, just a little bit below parity. The last month we were below parity at 95.46, and even before that at 94.61. But take a look at the closing levels of these candlesticks. 2 months ago, we closed at 98.25. Last month, we closed at 1.0036. This month, if we close right here, it'll be a lower closing price. Thick part of the candlestick is below the previous candlestick's thick part of it. So that is not so encouraging. Dollar Swiss is starting to turn to the downside. And by the way, this is a monthly chart. If we break those 94.61 lows, going back to October this year, go back on a monthly chart, going back to the 1980s, that's the lowest low we've seen. It's very, very difficult to ignore a very long trend to the downside. This looks like just another opportunity for the dollar to make new lows. And fundamentally, there's a lot of different ways we can sort of justify this. Personally, I think it has a lot to do with the budget deficit, that as the Treasury continues to print more and more dollars for these stimulus plans, it's more dilutive. It's a concept we talk about a lot. I happen to subscribe to. That the more dollars that the Fed tells the Treasury to print, the more dilutive it is to the dollar, and therefore the more reason for the dollar to go down. Now the final stage, I'm glad someone asked this. The final stage in technical analysis is moving from the long-term chart to a short-term chart to actually look for a trade entry. Long-term channel on the euro dollar shows us, we can kind of actually adjust this. Shows us, still we're looking at a channel to the upside, higher lows, higher highs all the while. Then go to a daily chart. So far we can see we've bounced off a recent support level. We're moving back to the upside. Zoom in on a daily chart and we can see we've surpassed the previous swing highs. We're actually making a little bit of higher highs. And all this tells us is the immediate trend to the euro dollar to the upside. In addition, we can draw downtrending resistance as follows. And that shows us a recent breakout. So even the daily chart showing us a trend to the upside. From that point moving forward, let us look at the 4-hour charts. 4-hour chart is showing us a possible reversal at this point. Why is this level important where we're reversing? Take a look at the previous 4-hour candlestick highs. That went up to 134.98. We'll round to 135. 135 is important because remember, former support becomes new resistance. These former lows of 134.45 November 16th suspected new resistance at this point. Also, former possible double top. Point being is that, number one, the trend is your friend. Euro-dollar long-term trend is the upside. So I'd much, much prefer to go long. I want to buy the euro-dollar in terms of its long-term trend, in respect to the long-term trend to the upside. But I don't want to buy here because not only are we really extended from the lows, it's also running right back up to a former support level, could be new resistance, a possible false breakout of a double top, and also the immediate candlestick is showing the signs of reversal. So the question is, where do I want to go long the euro dollar? Definitely not here. Drawn up trending support line on a 4-hour chart, the same rules apply. Let's make this a different color just to be 100% clear. There we go. That's where I want to go long. Uptrending support line connects significant lows in the euro dollar. The next most significant lows take us to the last recent swing lows. And the number is 132.08. 132 is where I possibly want to go long the euro dollar, where the euro dollar going long looks most attractive. We can also draw a parallel line of supports, a line parallel to supports, drag it up to connect our most recent significant highs. That actually makes a lot of sense. And I think that's what we're looking at. Possible resistance, if the euro dollar continues higher, is 135.80. But remember, trend is your friend. When a trend exists, always try to trade only in the same direction as that trend. And that's at the upside in the case of the euro dollar. Uptrending support, entry level near 132, target 135.60, approximately. That's how I see the euro dollar. And if we know support is at 132 level, we can make this line green. This is our entry. Just a little bit above support. And our protective stop orders will mark off with a red line a little bit below support. Take these other lines away to make it a little bit less confusing. That's how we see euro dollar. Euro dollar long term, am I bullish? Yeah. I'm not extremely bullish though. The euro has been recovering. Remember what happened a couple weeks ago with the real fear that spread through Western Europe in the Irish debt bailouts? And we read on Bloomberg.com during a couple webinars that, well, it could extend to Spain. It could extend to Portugal. It was a really scary time. It almost felt like Greece Part 2. You know, the country, not the movie. That we seem to be in a really scary part in terms of European economics for a period of time. Not that things have gotten that much better, but I think the scary part is over. The euro really got taken down as a result of that fear. So the euro, I think we might see some moderate amount of strength. I don't think the European Central Bank is going to raise rates anytime soon. But I think we're really recovering off of what was a scary time. Looking at daily charts, that scary time really peaked November 30th, just about 2 weeks ago. So euro dollar, yes, I am bullish. I think that the euro has a better chance to go up than the dollar. I think the European Central Bank will raise rates sooner than the Federal Reserve. I think they have more reason, at least, to raise rates before the Federal Reserve, but neither central bank, I think, has a lot of reason to raise rates anytime soon. So I'm moderately pessimistic on both the euro and the dollar. You put two negative currencies together, the market doesn't really move. You put two positive currencies together, two strong currencies together, the currency pair doesn't really move. What we want to do is put one currency that we think is going to be very, very weak against a currency we think is going to be very, very strong. When currencies move in opposite directions, that's when currency trends really develop. That could be eventually, I think, the pound dollar. I don't think quite yet. That's my 2011 strategy, is one of them, is that I think that eventually, the foreign exchange market is going to wake up and say, hey, UK CPI, it has already hit 6-month highs. The Bank of England, we already know there's one individual in the Bank of England, Andrew Sentence is his name. He's already voted a few times for the Bank of England to raise rates. There's more and more evidence that the UK economy is really improving and we should raise rates. We know the Bank of England also is a little bit more conservative in nature, meaning they're going to raise rates if they need to. I think the cable dollar and the cable yen, I think one day eventually are going to have really nice trends to the upside. I think we're a little bit early on that. The Aussie, if the stock markets break to new highs, Aussie dollar, Aussie yen. We took a look at the Aussie dollar. Aussie represents higher yielding currencies. It also tracks pretty closely the price of gold, which, by the way, is almost at new highs almost every week these days. So focus on those long-term trends. One currency pair that I think could really develop or continue in its trend is the dollar Swissy. Focus on the currency pairs with the greatest trends. There's an exercise we run through from time to time. I'm sure FX Street probably has it in their archives, where you identify the strongest trending currency pair by very simply going through the different daily charts and comparing the RSI levels, between the different currency pairs. We'll go through that exercise again one of these days. Try to find the strongest trending currency pair, because that has the greatest likelihood to continue, not only the trend, but the trend that has already established. Trend is your friend. It gives us a greater likelihood of just being right, for lack of better words. Stay away from those currency pairs with a lesser trend. Euro dollar, I think it could continue higher, but the trend is not very, very significant. I'm out of time. However, if you want to contact me directly, please do not hesitate to do so, www.forexlounge.com. I thank you very much for joining us. Please see FX Street's calendar, because we'll be back on later on, not only this month, but later on today for much, much more. We're covering the FOMC U.S. interest rate announcement. That is at 2:15. We will start at 2 p.m. Eastern. We thank you for joining us. We wish you a great day, all profitable trades, and we look forward to seeing you back.